What is the difference between a fixed rate mortgage and an adjustable rate mortgage, sometimes known as ARM or ARM? I have home buyers that ask me this question all the time, and I'm going to break both types of mortgages down to you so you can have a clear understanding of which type of mortgage would be good for you. My name is Cherilyn Williams, and I'm a realtor in the Chicagoland area, helping you build your dreams through real estate. And I always provide weekly real estate videos on home buyer education. So if you are interested in learning everything about the home buying process, please do me a favor and smash that like button, comment, share, and subscribe to my channel. I sincerely appreciate all of your support. So there's two types of mortgages a home buyer can get. You have the fixed rate mortgage, and then you have the adjustable rate mortgage. Now, as the name suggests for both of these, a fixed rate mortgage means you will have a fixed interest rate the entire time that you have a loan on your property. Pretty simple, nothing too fancy to understand. And an adjustable rate mortgage, or ARM, means that your interest rate can adjust either up or down at a certain point during your loan term. Also pretty self-explanatory, but it may sound a little bit scarier. Okay, let's start talking about the fixed rate mortgage first. Now, the fixed rate is the most common mortgage that most home buyers want and love. Why? Because the fixed rate interest rate is always stable. So you have like the typical loan term of a 15-year or 30-year, your interest rate will always stay the same. So you can always count on your principal and interest being the same. The only two criteria that can change over time in your monthly payment is your property taxes and your insurance. So every year when the county tax assessor, guy or woman, evaluates your property, your taxes will usually increase, and possibly your homeowner's insurance, which we all hate, of course. So you really have to be prepared for that increase in payment because of the taxes and insurance. Okay, so let me break this down a little bit more about your mortgage payment. When you get your monthly mortgage statement, your payment will have principal, interest, property taxes, and insurance, known as PITI or PITI. You can call it whatever you want. Okay, so this PI will stay the same, but the TI part will either increase or decrease. And we all know more than likely it will increase because it never works in our favor to decrease. Now, most people love a fixed rate mortgage because there's stability in the payment, which gives you peace of mind, and we all love that. And you know what? It just makes total sense to have a fixed payment. And this is the one that I will always recommend to you if you are a home buyer. So you can get a fixed rate FHA or conventional, and sometimes you can get a 10-year or 20-year fixed. It doesn't always have to be a 15 or 30-year. But what's great about a loan term less than 30 years is that you get to pay the home off quickly and you're paying less interest over time, which is great if you can do it. Okay, now let's discuss the adjustable rate mortgage. Now, with the adjustable rate mortgage, or ARM, it first starts off with a low interest rate and a lower payment. And most times the interest rate is way lower than a fixed rate mortgage. So if the current market interest rates are high like they are today, the ARM might be very attractive to you because that's what you want, right? You want to buy a home with a lower interest rate and a smaller monthly payment. However, with an ARM, at a certain point, your interest rate will change. You will always see on an adjustable rate mortgage, it's presented in numbers that look something like this. You may see a 5/1, which means a 5/1 ARM, or you may see something like a 10/1 ARM. The first number here on the 5 and 1 ARM means that your loan will be a fixed interest rate for the first 5 years and will adjust every year after. That's what the 1 means. Every year. Pretty easy to understand. Let's look at another example. Let's say you have a 5/6 ARM hybrid. So for this one, you have a fixed rate for 5 years, and then the interest rate can adjust every 6 months. And now for some of you, that sounds a little bit scary that your interest rate could change every 6 months. And because of this fear, that is why most home buyers prefer a fixed rate. It just makes better sense. And I don't know if many of you were around during the 2008 Great Recession or remember it at all. I'm sure many of you heard about it, but many of the homeowners that ended up foreclosing on their homes and losing their homes at that time had adjustable rate mortgages. And that's why so many people are afraid of them now. But there have been more guidelines and restrictions on adjustable rate mortgages than they were back then. The banks and the lenders were very relaxed on home buyers qualifying for an ARM. So we don't have that problem now. So an ARM may be something you want to consider. So you may be wondering why anyone in their right mind would want to have an adjustable rate mortgage. Well, like I said earlier, if you want to buy a home at a lower interest rate than a fixed rate, an ARM could be a very great way to buy a home with a lower interest and monthly mortgage payment initially. And that's why people do it. But if you're one that doesn't feel comfortable taking big risks and not knowing what your interest rate and payment may look like after that initial period, I would say to stick with a fixed rate mortgage. But you know what? It could work out great for you if you're someone that knows you don't plan to stay in your home for a very long time, but you just want to capitalize on the low rate and payment. An adjustable rate mortgage might be perfect for you. So let's say you decide to stay in your home for only maybe 3 years or so, and you plan to get out of there before that 5-year fixed period is over. Well, then an ARM could be great because you will never get to the point where your interest will adjust or change. But if you plan to be in your home a long time, you might want to go ahead with the fixed rate. Now, the ARM is calculated by an index and a margin, and the resulting number is known as the fully indexed rate. The index is just a general measurement of interest rates. So if you have an index of 2% and a margin of 3%, your fully indexed rate would be 5%. So this fully indexed rate here is the most important number to you because it determines the size of your monthly payments and the total amount of interest you will pay over time. And basically, this is all I really know about it because this is a lot of lender jargon, but please make sure your lender explains how all of this works to you if you're interested in doing an ARM. Now, some lenders will try and pull you in for an adjustable rate mortgage and say something along the lines of, don't worry about it. Go ahead and get the adjustable rate now with a lower interest rate and payment, and then later on in the future, you can refinance into a fixed rate mortgage. And you know what? I want you to be very careful here because a lender could only be thinking more about themselves and getting paid than about you. So as I mentioned, you always can refinance an ARM into a fixed rate before that initial period is over. And this would be a great idea to ease the stress of the payment ever changing. However, what if the current fixed rate is higher than what your ARM is? You could find yourself in a bit of a conundrum and not being able to refinance. And so you really never know what the interest rates could change to when you're ready to refinance. And like it is right now in our market, you can never predict what the interest rate will be. So this could be a real slippery slope for you. And even with a fixed rate, you can refinance if you have a higher rate when you first bought your home into a lower rate. But just remember that if you decide to refinance either mortgage types, you still will need to pay for closing costs, and your costs could be anywhere between 2 to 6% of the loan amount. Okay, so I hope you have a better understanding of fixed rate and adjustable rate mortgages. And if you have a fixed rate or an ARM, please help us and tell us in the comments what you like or dislike about your mortgage. You could possibly be helping some of my viewers out here. And if you're looking for a home in the Chicagoland area, get in contact with me and let's find you your new home. Thank you for watching.